Hello and welcome back, guys. So today what we will be discussing about is profit, loss and other comprehensive income. So what kind of items goes into profit, loss, and then what kind of item goes into OCI. So let's look at it. So there is a very distinct classification that has been prescribed as per IFRS. So let's look at it. So in this particular technical article of SBR, Strategic Business Reporting, what it says is that profit or loss and other comprehensive income. So that's the heading. And then this article looks at what differentiates profit or loss from other comprehensive income and where items should be presented. So let's look at it. The purpose of statement of profit or loss and OCI, other comprehensive income, is to show an entity's financial performance in a way that is useful to a wide range of users so that they may attempt to assess the future net cash inflows of an entity. The statement should be classified and aggregated in a manner that makes it understandable and comparable. So the statement should be classified and aggregated in a manner that makes it understandable and comparable for the users. IFRS currently require the statement to be presented as either one statement or being a combined statement of profit or loss and other comprehensive income, or two statements being statement of profit or loss and statement of profit or loss and other comprehensive income. So an entity has to show separately in OCI those items that would be reclassified to profit or loss and those items that would never be reclassified to profit or loss. So what are the items that will be reclassified? It is cash flow hedges, foreign currency, and then after that, debt instrument. So debt instrument is also reclassifiable. And then after that, what are not reclassified? It is revaluation surplus from IAS 16, and then the other is employee benefits IAS 19, and then after that equity, which is financial instrument. So fair value through OCI, which has been classified through fair value through OCI. So that would never be reclassified, right? So the related tax rates have to be allocated to these sections. That's pretty much it that we know. The profit or loss includes all items of income or expenses, including reclassification adjustments, except those items of income and expenses that are recognized in OCI as required or permitted by IFRS standards. Reclassification adjustments are amount recycled to profit or loss in the current period that are recognized in OCI in the current or previous period. So it is reclassified. An example of item recognized in OCI that may be reclassified to profit or loss are foreign currency gains on disposal of foreign operations. So any realized gains or losses on cash flow hedges. So these items that may not be reclassified are changes in revaluation surplus under IAS 16 PPE and actuarial gains and losses on a defined benefit plan under IAS 19 employee benefits. However, there is a general lack of agreement about which items should be presented in profit or loss and in OCI. The interaction between profit or loss and OCI is unclear, especially the notion of reclassification and when and which OCI items should be reclassified. A common misunderstanding is that the distinction is based upon realized versus unrealized gains. The common misunderstanding is that the distinction is based upon realized and unrealized gains. The lack of consistent basis for determining how items should be presented has led to an inconsistent use of OCI in IFRS standards. So it may be difficult to deal with OCI on a conceptual level since IASB, the board, are finding it difficult to find a sound conceptual basis. However, there is urgent need for some guidance around this issue. Opinions vary, but there is a feeling that OCI has become a dumping ground for anything controversial because of a lack of clear definition of what should be included in the statement. Yep, that's pretty much it. Many users are thought to ignore OCI. Yeah, many even in the media when you're looking at it, they just report the numbers, profit after tax. So they report PBT and then PBIT, or profit before interest, taxes, depreciation and amortization. So they look at it and they don't talk about the OCI item. They completely ignore it. And many financial statements users, primary users such as existing or potential investors, also don't have that sort of knowledge or they ignore it. So it says, even in the article, it says the same thing. Many users are thought to ignore OCI as the changes reported are not caused by operating flows used for predictive purposes. Financial performance is not defined in conceptual framework for financial reporting, but could be viewed as reflecting the value the entity has generated in the period. And this can be assessed from other elements of financial statements, not just statements of profit or loss and other comprehensive income. Examples would be statement of cash flows and disclosures relating to operating segments. The presentation in profit or loss and OCI should allow a user to depict financial performance, including the amount, timing, and uncertainty of the entity's future net cash inflows and how efficiently and effectively the entity's management have charged their duties regarding the resources of entity. Yep. That's basically the cash flows will help us like determine when the amount, timing, and uncertainty of the entity's future net cash inflows, and then after that, how efficiently and effectively the management stewardship towards the resource of the entity. So there are several arguments for and against reclassification. If reclassification ceased, then there would be no need to define profit or loss or any other total or subtotal in profit or loss, and any presentation decisions can be left to specific IFRS standards. It is argued that reclassification protects the integrity of profit or loss and provides users with relevant information about a transaction that occurred in the period. Additionally, it can improve comparability where IFRS standards permit similar items to be recognized in either profit or loss or OCI. Okay, so um, if reclassification is ceased, then there would be no need to define profit or loss or any other total or subtotal in IFRS because there is no reclassification, right? And what they have given us is it is also argued that reclassification protects the integrity of profit or loss and provides users with relevant information about a transaction that occurred in the period. Okay, so those against reclassification argued that recycled amount add to the complexity of financial reporting may lead to earnings management, and the reclassification adjustment may not meet the definition of income or expenses in the period, as the change in assets or liability may have occurred in a previous period because the gains or losses could have been incurred in a previous period, and then when it is reclassified, so the timing is particularly based upon the judgment of the management. So when there is a bigger profit, then they might actually reclassify it. So there is chances probability of earnings management. And also it does not meet the definition of income and liability expenses because in while we are defining income or expenses, we always have to We always define it as a decrease in increase in assets or decrease in liability in the current period. We say that, right? So it does not meet the definition as well. The other original logic for OCI was that it kept income relevant items that are possessed low reliability from contaminating the earnings number. Markets rely on profit or loss, and it is widely used. OCI figure is crucial because it can distort common valuation techniques used by investors, such as price to earnings ratio. That's important. Thus, profit or loss needs to contain all information relevant to investors. Misuse of OCI would undermine the credibility of net income. The use of OCI as temporary holding for cash flow hedging instrument and foreign currency translation is non-controversial. However, other treatments such as the policy of IFRS 9 to allow value changes in equity investment to go through OCI are not accepted universally. US GAAP will require value changes in equity investment to go through profit or loss. Accounting for actuarial gains or losses on defined benefit schemes are presented through OCI, and certain large US corporations have hard have been hit hard with losses incurred on these schemes. The presentation of these items in OCI would have made no difference to the ultimate liability settled. But if they had been presented in profit or loss, the problem may have been dealt with earlier. The assumption that an unrealized loss has little effect on the business is an incorrect one. The assumption that we normally make was an unrealized loss has a little effect on the business is an incorrect one. Yep. So if there has been huge amount of losses in case of actuarial losses in OCI, then it is not presented in profit or loss. So the investors, if it would have been presented, then investors would be more careful, right? So in this case, it has not been disclosed earlier on because of IFRS or because of US GAAP, whatever you want to say. So it really affects the investors. So the discussion paper on conceptual framework for financial reporting considers three approaches to profit or loss and reclassification. The first approach prohibits reclassification. So there are three approaches. The first approach is it prohibits reclassification. The other approaches, the narrow and broad approaches, require or permit reclassification. The narrow approach allows recognition in OCI for bridging items or mismatched remeasurements, while the broad approach has an additional category of transitory measurements. For example, remeasurement of defined benefit obligation would allow the board greater flexibility. So the narrow approach significantly restricts the type of items that would be eligible to be presented in OCI and gives the board little discretion when developing and or amending IFRS standards. The narrow approach is recognition of OCI for bridging items. So this would give board little discretion when developing or amending IFRS standards. A bridging item arises when the board determines that the statement of comprehensive income would communicate more relevant information about financial performance if profit or loss reflected a different measurement basis from that reflected in the statements of financial position. For example, a debt instrument is measured at fair value in statement of financial position. Okay, debt instrument is being measured at fair value in the statements of financial position, but it is recognized in profit or loss using amortized cost. then amount previously reported in OCI should be reclassified to profit or loss on impairment of disposal of, on impairment or while it is disposed of. The board argues that this is consistent with the amounts that would be recognized in profit or loss if the debt instruments were to be measured at amortized cost. Yeah, that's also true, because even though if it is measured at amortized cost, you would be receiving the same amount of money at the end of the period, and then the profit or loss would be charged to SOPL, and then in this case, though in the OCI it is just unrealized amount, but um, what you would do is that you would reclassify it back, so the net effect is same. So the board argues in that way a mismatched representation arises when an income of a mismatched remeasurement arises when an item of income or expenses represents an economic phenomena so incompletely that in the opinion of the board, presenting them in profit or loss would provide information that has little relevance in assessing the entity's financial performance. An example of this is when a derivative is used to hedge a forecast transaction. Changes in the fair value of the derivative may arise before the income or expenses resulting from the forecast transaction. The argument is that before the result of the derivative and the hedged item can be matched together, any gains or losses arising from the measurement of the derivatives, to the extent that the hedge accounting is effective and qualifies for hedge accounting, should be reported in OCI. Subsequently, those gains or losses are reclassified to profit or loss when the forecast transactions affects profit or loss. This allows users to see the results of hedging relationship. The board's preliminary view is that any requirement to present a profit or loss total or subtotal could result in some items being reclassified. The commonly suggested attributes for differentiation between profit or loss and OCI: realized, unrealized, frequency of occurrence, operating, non-operating, measurement certainty or uncertainty, realization in short, long term, or outside management control are difficult to distill into a set of principles. Because if you're looking regarding, so if you are looking at fair value through OCI, in case of equity, you could say it's a long term one, and then it's unrealized as well. Then the frequency of occurring might not be same, you could say, whereas, so it's very hard to actually set a particular principle to say like the frequency of occurrence must be there or whatever. So therefore board has, what they have done is they have suggested two broad principles, namely profit or loss provides the primary source of information about the return an entity has made on its economic resource in a period. To support profit or loss, OCI should only be used if it makes profit or loss more relevant. So OCI should only be used if it makes profit or loss more relevant. The board feels that changes in cost-based measures or gains or losses resulting from initial recognition should not be presented in OCI, and that the results of transactions, consumptions, and impairment of assets and fulfillment of liabilities should be recognized in profit or loss in the period in which they occur. As a performance measure, profit or loss is more used, although there are a number of other performance measures derived from profit or loss and OCI. Yep, non-performance. I mean, other performance measures such as non-financial measures or Any other kind of measures are particularly used to reflect this particular information as well. So, but it's not defined as the IFRS standard. So, IFRS does not require which other performance measures to disclose. So, it's kind of a bit hard. Okay, so yeah, it's always been the controversy. So, there has been three approaches that we need to remember. So one is broad, one is narrow, and the other is, where did that thing go? Is prohibit. One prohibits, the other is narrow, the other is broad approach. So the most important thing that we need to remember is that profit or loss provides the primary source of information about the return an entity has made on its economic resource in a period, and then to support profit or loss, OCI should only be used if it makes profit or loss more relevant. Okay, so this is the most important thing, that whether the information is providing more relevant information or not, that's more important. And then profit or loss is solely the result of the return an entity has generated over the period. So that's pretty much it, guys. So let's look at some other articles as well, in whether after a couple of days or like within next session or somewhere, and then let's discuss about it as well. And then we'll definitely go slowly with these articles and try to finish all of them. So until next time, bye bye.